Hi everyone, welcome back to the Investing Iguana, the channel where we talk about all things related to investing and finance. I'm your host, Iggy, and today we're going to discuss a very important topic, the U.S. Federal Reserve's interest rate decision and what it means for Singapore stocks. As you may know, the U.S. Fed is the central bank of the United States, and it has the power to set the benchmark interest rate for the U.S. economy. This rate affects how much it costs to borrow money and also influences the value of the U.S. dollar and other currencies. The Fed adjusts this rate depending on the economic conditions and its policy goals, such as keeping inflation under control and supporting growth and employment. Economists and analysts expect Federal Reserve officials to hold interest rates steady at their policy meeting this Wednesday, but keep the door open for at least one more hike. Fed officials have signaled they are prepared to pause on a new hike this month as they take more time to assess data that suggests inflation is cooling. However, they are also likely to indicate that they are willing to raise rates again if necessary to bring inflation down to their 2% target. The Fed's goal is to eventually push the core inflation figure down to 2%. Core inflation, which strips out volatile food and energy categories, rose 4.3% in August, a slowdown from the 4.7% increase seen in July. Rates now stand in the range of 5.25% to 5.5%, following 11 hikes since March 2022 that represent the most aggressive action from the central bank to tackle inflation since the 1980s. Why is the Fed likely to hold rates steady? The Fed is likely to hold rates steady because it wants to see more evidence that inflation is cooling before raising rates further. The Fed is also concerned about the potential risks of raising rates too quickly, such as triggering a recession. Why is the Fed keeping the door open for a further hike? The Fed is keeping the door open for a further hike because it wants to make sure that inflation is under control before it begins to cut rates. The Fed also wants to avoid repeating the mistakes of the 1970s, when it cut rates too quickly and allowed inflation to spiral out of control. So what does this mean for Singapore stocks? Well, as a small and open economy, Singapore is highly exposed to external shocks and influences. The U.S. Fed's interest rate decision can have significant implications for Singapore's economy and financial markets, such as the exchange rate. The Singapore dollar is not immune to the movements of the U.S. dollar, as it is one of the major currencies that the Singapore dollar is benchmarked against. This means that when the U.S. dollar strengthens due to higher interest rates or expectations of higher interest rates, the Singapore dollar tends to weaken accordingly. This can have both positive and negative effects for Singapore. On one hand, a weaker Singapore dollar can boost exports and tourism by making Singapore's goods and services cheaper for foreign buyers. On the other hand, a weaker Singapore dollar can also increase import costs and inflation by making foreign goods and services more expensive for domestic consumers. The interest rates. The U.S. interest rates also affect Singapore's interest rates, as they influence the cost of borrowing in U.S. dollars and other currencies. When the U.S. interest rates rise or are expected to rise, Singapore's interest rates tend to follow suit, as lenders demand higher returns for lending money. This can have both positive and negative effects for Singapore. On one hand, higher interest rates can attract more capital inflows and foreign investment by offering higher returns for savers and investors. On the other hand, higher interest rates can also dampen domestic demand and investment by making borrowing more expensive for households and businesses. The stock market. The U.S. interest rates also affect Singapore's stock market, as they influence the valuation of stocks and their expected returns. When the U.S. interest rates rise or are expected to rise, Singapore's stock market tends to fall or underperform, as investors demand higher returns for holding stocks or shift their money to safer or more attractive assets. This can have both positive and negative effects for Singapore. On one hand, lower stock prices can create buying opportunities for bargain hunters and long-term investors who are looking for undervalued or high-quality stocks. On the other hand, lower stock prices can also erode investor confidence and wealth by reducing the market capitalization and profitability of listed companies. So how should you invest in Singapore stocks in light of the Fed's interest rate decision? Well, there is no one-size-fits-all answer to this question, as different investors have different risk appetites, time horizons, goals, and strategies. However, here are some general tips that you may want to consider. Diversify your portfolio. One of the best ways to reduce your exposure to any single risk factor or market movement is to diversify your portfolio across different asset classes, sectors, regions, and currencies. By doing so, you can reduce your overall volatility and enhance your risk-adjusted returns. For example, you may want to allocate some of your portfolio to bonds or cash equivalents that offer stable income and capital preservation, especially if you are nearing retirement or have a short-term goal. You may also want to invest in some foreign stocks or funds that can benefit from a weaker Singapore dollar or a stronger U.S. economy, especially if you have a long-term horizon or a global outlook. Focus on fundamentals. Another way to navigate the uncertain and volatile market environment is to focus on the fundamentals of the companies that you invest in rather than the noise and sentiment of the market. By doing so, you can identify and invest in companies that have strong competitive advantages, solid financial performance, attractive growth prospects, and reasonable valuations. These are the companies that can withstand the challenges and opportunities posed by the Fed's interest rate decision and deliver consistent and sustainable returns over time. For example, you may want to invest in some of the best Singapore growth stocks that have been identified by Dollar Bureau, such as DBS Group, Sheng Xiang Group, Singapore Exchange Limited, United Overseas Bank, and Singtel. These are companies that have proven track records, dominant market positions, diversified revenue streams, and resilient earnings growth. Be flexible and adaptable. The last tip is to be flexible and adaptable to the changing market conditions and opportunities. The Fed's interest rate decision is not set in stone, and it can change depending on how the economic data and the policy outlook evolve. Therefore, you should not be too rigid or complacent with your investment plan, and you should be ready to adjust your portfolio allocation and strategy accordingly. You should also be open-minded and willing to learn from new information and perspectives, as well as from your own mistakes and successes. By doing so, you can improve your investment skills and knowledge and enhance your investment performance over time. That's all for today's episode of the Investing Iguana. I hope you enjoyed it and learned something new. If you did, please give this video a thumbs up, share it with your friends and family, and subscribe to my channel for more investing tips and insights. Also, don't forget to hit the bell icon to get notified of my latest videos. Thank you for watching, and I'll see you in the next one. Stay safe and happy investing.